Hey everyone, good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show, episode number 5.
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balkin.
Thanks for coming back to the show. Firstly, my thoughts and prayers are with everyone affected by this health pandemic known as COVID-19 or the coronavirus. I truly believe that everyone has been affected in some type of way. My prayer is that everyone that is ill become healed, those that have lost loved ones can be comforted, and those that are out of work can get back to work and things can just get better from here. In the last show, we started talking about buy and hold real estate investing. Just as a short review, you'll recall, or you should recall, we talked about debt and leverage. Hopefully you remember that there is good debt and bad debt, and you were introduced to what good debt can be, the power of leverage, the math behind all of this buy and hold real estate investing, which you saw is quite simple, and our first income stream, or first type of income stream, not the only income stream, but the first type of income stream that comes from buy and hold real estate investing. So in this show, we're going to continue and get into our second income option or opportunity with buy and hold real estate investing. And that's going to be sell or refinance type of income, which ties in with appreciation, mortgage principal pay down, which could be seen as a third income opportunity or stream, depreciation, and tax benefits. So sell or refinance income and appreciation. Let's take these one at a time. When you sell something, it's typically based on the value of what it is you're selling, or it could be based on the perceived value that the buyer is willing to pay. So real estate is not much different when it comes to that, except you're going to have factual information or factual data you'll be able to show to prove what the value of the real estate investment or asset is. You're going to learn in future shows how to put together that data to present. And you're also going to learn in future shows another concept that is imperative for when you buy. So you're going to learn how to analyze the data that is given to you or that is published to you so that you can determine what the actual value of the asset or investment is that you're investing in or acquiring. That's going to be very important whether you're an active investor purchasing your own assets or a passive investor investing in the assets of others who are investing. It's going to be imperative to understand what the value of the asset is that you're investing in or purchasing in. Again, you'll learn that here in future shows. So why sell? Well, why do you sell anything? Maybe you just don't want it anymore. Maybe you want something bigger. Maybe you want something smaller. It's just going to depend on your goals maybe when it comes to real estate investing. I think no matter what the reason you sell, all of it encompasses that you get typically cash in return for what it is you're selling. So we're going to use that for the example here, because after you have the cash back, you can do whatever you want. Maybe you do buy something bigger. Maybe you do buy something smaller. When you sell the real estate asset, is there a profit? Well, there should be. Firstly, because again, the cash flow you received over the months and years that you owned or invested in the real estate asset. But secondly, when you sell it, it could be worth more than it was when you purchased it. Let's just say, for example, that it was not worth more when you sold it than it was when you purchased it. It was the same price. So year one, you purchased it for $500,000, and then in year 5, you sold it for $500,000. Now, a point of note, just because you acquired or purchased a real estate asset that cost $500,000, you'll recall from the last show that because of the power of leverage, it doesn't mean you had to have $500,000 in cash to acquire that asset. You just need to use the power of leverage to do so. And if you don't know what I'm talking about, go back and listen to episode 4, the last show, and you'll see what the power of leverage allows you to do. In quick summary, the power of leverage allows you to acquire real estate assets at a fraction of the purchase price. So maybe 20, 25, 30% or so on the purchase price of $500,000. So 20, 25, 30% down to acquire $250,000, $500,000, $1 million in real estate or more. Don't you think that's powerful? Anyhow, back to this example of what happens when you sell a real estate investment or asset. So you acquired the asset for $500,000 in this example. Let's bring in a handy calculator just to show the math. So you acquired the real estate asset in the first year for $500,000. And 5 years later, you sold it for $500,000. We don't need a calculator to see that the profit would be zero. It's simple. But what you might want to see in a calculator is if that asset brought in $15,000 a year in cash flow, or which again, cash flow being the income from your rental or lease payments that come in each month or quarterly or yearly. After all expenses and debt are paid, let's say there was $15,000 in cash flow each year, and you owned that asset for 5 years. Well, it turns out you did make a profit. So even if you bought the asset and sold it at the same price years later, the cash flow that you had during the year, that netted you $75,000. So maybe not a bad deal after all. So even if the real estate didn't change value at all in the years, the 3, 5, 10, 20 years you owned it, you still collected cash flow or a check each month or quarterly or yearly. So you received an income stream no matter what. That's the difference between real estate assets or investments and other type of investments out there. We saw with stocks in the prior episodes that although could be good investments, some stocks do not pay dividends. So you don't collect any income until you sell the stock, and hopefully, or you better sell that stock when it's at a higher price than it was when you purchased it. Otherwise, you have no income. Now, the stocks that pay dividends, that does help because you get a percent of the stocks that you own. You get a percent of the shares in return as a dividend or a return or a yield. So similarly, the real estate gives you a cash flow always, or it should give you a cash flow during the time that you own or invest in that real estate asset. Now we saw what happens if the real estate asset did not change in value from the time you purchased it to the time that you sold it, for whatever your reason might be. But what if it did increase in value? All right, this is exciting stuff. So we're going to need a little bit bigger calculator. Let's expand it a little bit here. So what if $500,000 changed to or increased in value from the first year to the second year by 2 or 3%? Because real estate, it actually does increase in value, typically 2 to 3% per year. It can vary from region to region. Some will be a whole lot more, some will be slightly less. But let's just say that from the first year to the second year, it increased in value by 2.5%. So now that $500,000 real estate asset is worth $512,000. And let's say from year 2 to 3, it went up again. So now it's $525,000. And let's say it did it again the year after that, and again the year after that. So after 5 years, that $500,000 real estate asset or investment is worth $551,000. $551,906 to match what the calculator shows here. So if you sold this asset after, we'll say 5 years, for example, it could be 10 years, could be 20, but if you sold this asset after 5 years, it would be valued, in this example, $551,906. So not only is the asset valued at that when you sell it, but you also collected the $75,000 over the time that you owned it. So $626,906. If we subtract what you paid for it, obviously, the difference in value is $126,906. So that is the income you will have received from that asset. Now, would that make a difference in your life? With that cover, is that better than what you would have gotten in your savings account if you put this money into a savings account? Will that cover your child's college education? Does this make a difference in your life? That's a significant amount of money. That's a person salaries over the years that would be a gain or income potentially into your pocket. Now that is a significant amount of money, especially when you didn't do a whole lot or equivalent amount of effort to gain that income or that money. You didn't have to go to work each day to gain this income or this value. Not saying you wouldn't have had to do something, but you wouldn't have had to put in an equivalent amount of time to gain this value or this dollars or this income stream. That's real estate investing. That's powerful stuff. So what is this? Where did this value come from? What is it? So it's not magic. It's called appreciation. I'll circle appreciation here. I believe it was episode 1 that we talked about inflation. Inflation being the difference in cost of everyday goods and services, usually measured from year to year. And usually it goes up from year to year, about 2%, we said. So real estate similarly increases from year to year as well. Not for necessarily the same reasons as inflation increases, but it does increase. And real estate will typically increase 2 to 3%. And it's going to vary from region to region. Some regions might have real estate appreciation at 3, 5, 8, 10%, and some regions might be less. The higher appreciating regions may come from job growth, and job growth brings population growth, and as the population growth rises, people need places to stay. So partly supply and demand is part of the reason that real estate increases over time as well. So there's different types of real estate appreciation when it comes to real estate investing and buy and hold real estate investing. What I'm talking about right now is natural appreciation, where usually for different reasons outside of your control as the owner or the investor, real estate will appreciate. Sometimes because of supply and demand, as I said, job growth equals population growth, and people need places to stay, so there's a need for real estate. Job growth could also mean that the employers that are bringing the jobs need places to put the employees. Maybe they need bigger factories, or they need to expand their stores. Remember that all of that is still landlord, owner, investor versus tenant relationship. Whether it's a store or an industrial company or a restaurant, all still the same relationship when it comes to there's real estate involved. So as I looked at the data for the last 10 years, and this data is from Zillow.com, and measuring real estate values or appreciation or different parts of real estate can be measured in all different types of ways. I took 2 metrics. I looked at home values from real estate, courtesy again, Zillow, for the last 10 years, and there was on average 3.3% growth over the last 10 years. So there were some parts late 2008, 2009, 2010, 2011 where there was some negative values, and then there were some highs and 7%, 4%, 5%, but that equaled out to about 3% over the last 10 years, from 2010 to 2020. It equaled out to about 3.3%. I also looked at rent over the last approximately 10 years, and the rent growth was about 2% on average each year. There was a couple years where it was negative 0.03%, or it was flat where it didn't increase, but for the most part there were increases of 1.5 to 2.5, a year or two of 4% increases, but on average that equaled about 2% over the last 10 years. So again, that 2 to 3% on average for the US seems to be about right. So in the last example, we used 2.5%, and that was in the middle. So you can see, even with that appreciation on that $500,000 investment, it appreciated $51,000 over the 5 years, 2.5% each year. That was being pretty in the middle, pretty conservative. You can see that wasn't a reach. We weren't exaggerating in that number. That's pretty normal to have 2% or 2.5% growth each year for your real estate investment. And remember, even if it doesn't increase at all, you still have the cash flow, the income stream, or the income from the real estate asset itself. So if that's natural appreciation, where the real estate asset increases in value for reasons that might be outside of your control, the asset increases, the rent or the income increases. What is forced appreciation? So before we talk about what it is, why would you do it? Why would you force appreciation? Well, with real estate, there's a built-in luxury that gives you more control in compared to other investments. And I know I keep making the comparison to the stock market, and I'm only doing that because I want you to know your options. When you invest in stocks, you typically have no control over the day-to-day management or what takes part in that business. You can do very little to influence the income that company brings in or the expenses that company spends. You just typically don't have that type of control. With real estate, there is more control. The active investor or owner or operator can perform things to the real estate asset that have a direct impact on its bottom line. So what it brings in terms of income and what goes out in terms of expenses. Now, if you're not an active investor and you choose to invest in real estate passively, you won't have as much control, but you had your reasons for choosing that because you wanted to do something else with your time, whether that was continuing in a busy career or something you enjoy, or just something else you want to do with your time. But you still wanted to invest in something that gives you a good return on your investment and does not come with a lot of volatility to that return, so not a lot of ups and downs. So why do we want to force appreciation? Well, partly for the same reasons as natural appreciation occurs. You want to increase the cash flow and you want to increase the value of the asset. And you're going to see and you're going to learn in future episodes or shows here that there's a direct correlation between cash flow and the value of the asset. But in either case, you force appreciation because you want to increase the cash flow and you want to increase the value of the asset. And because you don't want to have to wait years for the increases to occur. So there's different types of real estate assets. There's industrial, there's retail, restaurants, residential. We all live somewhere. So let's start with residential. We should be able to all relate to that. So when you look for somewhere to live, what are things that you think about? Location, number of bedrooms, number of baths, the overall size of the home or the apartment you're looking to buy or lease. All those things factor into a budget that hopefully matches at least your needs and maybe some of your wants. But all those things have a correlation to the price that you'll have to pay. Things that might add to that would be amenities like maybe free Wi-Fi, a garage or carport, gated access for security, maybe a smart home, a smart house or apartment that features like electronic locks that you can control from your phone or a key fob, a thermostat you can control from your home. The list probably goes on. From the perspective of the investor or the owner, you want to provide the features or the amenities that the tenant would be looking for. Now, you probably won't be able to change the location of an existing building or apartment building or structure, and it may not be economical to change the size of it either, but there's things you might be able to change with the configuration on the inside. When you think about a home or an apartment, maybe it's economical to rearrange the baths and beds to get more of one versus the other, depending on the needs of that neighborhood or that community. Of course, kitchens and bathrooms sell. People are willing to pay more for upgraded kitchens and bathrooms. So if you're doing a renovation to an apartment building for a tenant to lease, kitchens and bathrooms are where you want to focus a lot of your time. But there's other things too with amenities. People will pay more for Wi-Fi. Maybe a garage isn't in the budget for the investor or the owner, but a carport might be. People will pay more for that at times for their vehicles. Gated access that makes people feel more secure is another amenity people might be willing to pay for, and it could be economical or affordable for the investor or owner, depending on the layout of the building or of the structure. Smart homes, people care more and more about electronic locks and electronic thermostats and light bulbs and all those type of things that you can control from your phone. People may pay more for that depending on the neighborhood and the community that your property resides in. Now, you don't want to guess at these things. You'll want to be aware and look at the surrounding neighborhood or community that your property resides in. We could spend a whole show just on market research, and we probably will. But you don't want to guess at this. You will want to look at properties that are similar to yours in the same region or the same neighborhood, same community, to first see if those properties have the renovations or the amenities that you're thinking about considering for your own property, and if the rental or lease income is higher because of that. Because if you're trying to force appreciation, you're trying to, in this case, increase the income. Market research can go into demographics such as the people also. For example, you probably wouldn't want to install carports in a community where most people use public transportation because they may not have cars. Similarly, you might not want to outfit houses or an apartment building with smart technology with electronic locks and light bulbs and thermostats that you can control from your phone when the age demographics for the community reflect people who might not use that technology. And if they're not going to use it, they're probably not going to pay for it. Okay, so we've talked about opportunities to increase income via renovations and amenities, and we've given some examples. And there's probably many more opportunities and examples as well. But I think you've got the understanding. Let's take a look at decreasing expenses, which is the other half of cash flow. So some of the things you can do to decrease the expenses of a real estate asset, and some of the things I have done, and it's going to depend on the property as well, and I'll explain to you why, are water saving fixtures and toilets. So this is going to depend on who's paying the water utility. If it's the investor or owner, you save in cutting down the expenses of your water utility bill. And if the tenant pays the water utility, maybe you're not decreasing your own investor or owner expenses, but you're doing a good deed for the environment. And maybe this will fall under an amenity for the tenant instead, because their water utility bill will be less. Lowering electrical costs, and we'll say gas costs too, lowering electrical and gas costs. So again, this is going to depend on who's paying the utility, the investor, owner, or the tenant. But things you can do can be as simple as light bulbs, going to LED light bulbs from incandescent, replacing furnaces that use more electricity or especially gas. Perhaps investing in solar panels depending on the region that your property sits in. So what about all these utilities? Who pays what and why? Well, it depends on the market. It depends on the neighborhood. It depends on the community. So this is again around market research. If you have a real estate asset that you invest in or own, and your asset or property, the investor or owner pays the gas utility and the electric utility and the water utility, but the surrounding properties or assets the tenants pay, it probably makes sense to transition those costs to the tenant so that you are equal to or similar to the market. You can do that in multiple ways, and it depends on the region or the municipality or city that your property sits in, and it may also depend on the structural layout of the property. The reason why all this matters is because of the meters, the electric meters, the gas meters, the water meters. Some municipalities will require that in order for the tenants to pay individual electric or gas or water utilities, that there must be individual meters per tenant. And some municipalities will not require physical meters for electric, gas, and water, but they'll have a ratio or a documented way to distribute those costs from the investor or owner to the tenant. And that might come based on square footage, that a tenant pays a certain percentage of the utility bills based on their square footage. Some might be based on occupancy, depending on the number of occupants that might live in an apartment. They pay the utility bills based on that percent. So it varies from region to region and specifically municipality to municipality. If you're in a municipality that requires physical meters to be present per tenant, if the tenants are going to pay a certain portion or any of the electrical utilities, the building structure layout becomes very important, because it could be difficult to install a water meter, for example, in individual apartments or individual tenant spaces or stores, depending on the layout of the plumbing. And similarly with gas, and especially true with electrical. So if your property or asset sits in a market or neighborhood or community where the investor or the owner pays all the utilities, you're probably going to have to fall in line there. You might could try something and maybe offset some to the tenant, but you're probably going to have to fall in line with the neighborhood or the community so that you don't lose your tenants. But if the market shows you should be offsetting some or all of your utility costs from the investor or owner to the tenant, then you probably should look into doing that. That is a direct way to decrease expenses. The upfront cost could be expensive, especially if you're in a municipality that requires physical meters per tenant and those physical meters are not already there. But the long-term savings is probably going to be much more, especially if you plan on keeping the asset for a long time. Or even if you do sell, the next buyer will find a financial gain in having reduced or no utility costs, a financial gain they'll be willing to pay you for. I didn't explain what RUBS means, but RUBS stands for Racial Utility Billing System. So I stated that some municipalities will not necessarily require a physical meter that tracks the individual use of electric, gas, and water for each tenant, but they may have instead a documented formula based on square footage or occupants, and they relate that to the percentage of the utility bills that the tenant should pay. So that's Racial Utility Billing System, or as we call it, RUBS. The Racial Utility Billing System costs the investor or owner very little to implement. It's really just math and documentation. So it's something that the investor or owner or their staff may wish to take care of internally, or there's organizations that handle billing like this specifically. So you could outsource this task if you wish to. So managing better or more efficiently. For me and for others, this is all about the people. This is the people that you have taking care of your real estate asset or your property. So this is the people that your tenant or your customers come in contact with. Again, whether it's an industrial tenant or a restaurant tenant or a retail store tenant or a residential tenant who is living there in a house or an apartment, these are the people that are interacting with your customer or tenants. So how do they do it better? How can you make sure they do it better than maybe their last investor or owner, or do it well? So one thing is handling tenant requests quickly, from questions that might come in electronically or by the phone, just handling those requests quickly. Maintenance requests that might come in, again, handling those requests quickly. You yourself, when you have an issue or you have a question, you want that answer taken care of in a pretty efficient manner. So your customers or tenants should be no different. And happy customers will likely stay longer, and that means less turnover costs in terms of cleaning or renovating for the next tenant, and vacancy due to downtime and there being no tenant. So that is a way to decrease expenses. The other thing is fixing it right the first time in terms of maintenance and maintenance staff, making sure you hire the right contractor or right employee for the right job, making sure they're doing it right the first time so you're not paying for the same thing to be fixed or repaired multiple times. This can be tied into your renovations or amenities that you might do to increase income too. When you're selecting the materials or selecting the people that are going to install those materials or perform those renovations for you, just making sure that you don't necessarily always go with the cheapest thing or maybe the most expensive thing, but something that provides a great quality, something that's going to be durable so that you don't have to buy that material again. So that may come into consideration with the paint you select or the materials you use for flooring or for kitchens or baths, etc. One thing I try to live by in the business is we don't want to have to pay for the same thing to be done again. We don't want that floor to have to be replaced because we picked the wrong floor, a floor that wasn't built for the amount of traffic that was going to take place over the years. Something as simple as a kitchen faucet that wasn't built for the amount of use that it was going to get. And these mistakes may seem little one time, but if you install the same flooring in 4 or 5 different buildings or 50 or 60 different apartments, or the same faucet in multiple buildings or multiple apartments, and there's a problem, you can see that the repeat cost or repeat maintenance visits or repairs quickly calculates into a huge expense. And what's more than that is you're going to learn in future shows here that you have a budget for these renovations or amenities and things you want to change. And you'll have a maintenance budget as well for just operational things that need to be repaired or fixed along the way. But the budgets are not unlimited. Otherwise, these things become opposite on the screen here. Instead of increasing income by renovations or adding amenities, these things have become an expense. And you're not increasing your cash flow, but instead you've decreased it. So it's important to do this right. And you're learning how to do this right by being here. So I think with all this, you understand what decreasing expenses is when it comes to forced appreciation in real estate assets. So we can check this off for now. We've talked about the fixtures and water saving measures when it comes to energy, electric and gas, ratio utility and billing system to use when needed depending on the municipality. And we just talked about overall, just managing better or more efficiently. And again, coming down to the people and how you do things, maybe the materials you select, all the above. So as we bring this show to a close, let's take a look at what we learned today. Firstly, we learned about selling your real estate asset. Why would you sell your real estate asset? And what happens after you sell it, or what happens when you sell it? What happens when you sell it is directly tied to appreciation. We learned about natural appreciation and forced appreciation. In the next show, we're going to move on to refinance. We'll finish a little bit more about selling your real estate asset. We're going to move into a very powerful tool of refinancing in real estate. We'll continue on with mortgage principal paydown, depreciation, and tax benefits. Hey, I hope you enjoyed the show, and hopefully it wasn't too much to learn in one day. But don't keep the knowledge to yourself. Share this show with someone else, and I'll see them and you back here next time as we continue on this real estate investment journey. As always, if you have a question or have a comment, I can be reached at neelyrealty.com/engage. That's NILEE realty.com/engage. Stay healthy, stay safe, stay sane, and stay inside.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.